The views and opinions expressed herein are as of the date recorded and should not be construed as an offer to buy or sell any securities. Such views and opinions may differ from those of Private Asset Management or its affiliates and are subject to change without notice. Private Asset Management has no obligation to provide updates or changes.
Hello, and welcome to the third quarter economic update. I'm Jeff Witt, Chief Investment Officer of Private Asset Management. Today, I'm going to give a quick overview of the U.S. and global economy, discuss returns, market returns, and our outlook for the market. The global economic backdrop continues to improve with synchronized growth occurring around the world. Whereas in the past, the U.S. was the driving force of the world economy, it now appears to be a more balanced growth environment. As a result, the IMF is increasing their global economic projections for GDP around the world to a rate of 3.6% for 2017 and 3.7% in 2018. This would mark a significant improvement from the 3.2% that we saw in 2016, which happened to be the slowest rate of growth that we'd seen since the financial crisis. It's not surprising, then, that their outlook for the probability of recession has improved as well. This positive outlook is also confirmed by recent survey data, which indicates that expansion is occurring in major economic regions around the world. Please remember that a level of 50 on these readings is a demarcation between expansion and contraction. Turning to the U.S., the third quarter U.S. GDP expanded at the rate of 3%, which was essentially in line with the prior quarter. Personal consumption continues to drive the economy, but we're also seeing corporations increase capital spending, which is a welcome development. We did see a significant inventory build in the quarter, which positively contributed to GDP, and we'll be closely watching this to ensure that inventory levels are not becoming problematic. However, we suspect that some of the inventory build was likely due to bottlenecks associated with the recent hurricanes in the U.S. One of the more interesting items to note is that the economic gap that opened up following the Great Recession has largely been closed. The CBO estimates a potential GDP for the U.S. and then compares it to its actual performance. When the economy is performing at less than potential, an output gap opens up. The closure of this gap means that the U.S. economy is performing at potential, and we have put to work many of the idle resources and labor slack that resulted from the Great Recession. As a result, we suspect that U.S. GDP will start to normalize around the CBO's estimated potential growth rate of around 1.7%. Normally, when an economy is performing at potential, things start to overheat and inflation can rise. This is why the Fed has been hiking interest rates. However, the lack of inflationary pressure has been a hallmark of this recovery, and recent consumer sentiment surveys have shown that inflation expectations are falling. We believe this will likely keep the Fed as very cautious in interest rate hikes, and the pace of these hikes will be slower than previous cycles. The orange line in this chart reflects the Fed funds rate, which has held steady in the quarter at a range between 1 and 1.25%. However, one thing I did want to highlight is that the real rate, or inflation-adjusted rate, since the recession, this rate has actually been negative, but just recently it is hitting the zero and possibly going positive. This will likely mean that future rate hikes will have more of a, quote, bite going forward. Continuing on the topic of interest rates, the Fed also recently commenced its balance sheet normalization process, whereby it is lowering the amount of bonds that it holds. In isolation, we could expect this would put upward pressure on interest rate, but the impact so far has been somewhat nominal. In our opinion, this is because the U.S. was not alone in its quantitative easing, and both the ECB and the Bank of Japan continue to expand their balance sheets. As you can see in this slide, while the Fed is reducing its balance sheet by about $10 billion per month in the fourth quarter, both the ECB and the BOJ are still significantly increasing theirs. However, starting in 2018, the ECB will reduce its purchases to a level of 30 billion euros per month, and the Fed will continue to increase the pace of their balance sheet reduction. This could make interest rates more volatile as we move into the new year, which could have economic consequences. However, for the fourth quarter, we believe it will be steady as she goes. Moving on to market returns and valuations. Equity markets continue to outperform, with international markets really leading this performance. Fixed income returns have been in the low single digits, and the global hedge fund index has not done much better. The Bloomberg Commodity Index is still down for the year, but there are some signs that commodity prices are firming. Looking at sector returns for the quarter, technology continues to power ahead, but notable change was that the energy sector posted the second best returns in the quarter. On the flip side, the consumer sectors both underperform the market as heightened competition continues to weigh on these sectors. One concern that we have noted is that valuations are elevated in the market, so there are few bargains out there to be bought. This is not just in the equity market, but also in most other asset classes as well. Some of the higher equity valuations or multiples can be explained by the anticipated for faster earnings growth in the next few years, which is represented here by the shaded bars. Should these growth rates materialize, then the valuations would not be so stretched. Another point that I'd like to make is that higher valuations are not a great near-term forecasting tool. While there does appear to be somewhat downward trend showing that higher valuations do lead to lower equity returns in the subsequent year, there's a lot of dispersion around this trend line. However, if we look at relative valuations over the next 5-year annualized returns, you can see there's a higher correlation and less dispersion. Therefore, I think that it's safe to say that higher valuations might not tell us what's going to happen in the near term. I think investors would be wise to assume that returns will be lower over the next 5 years. The higher valuations here represented by price to book value are broad-based, and most sectors are trading above their 10-year median. International markets, represented by the right two box plots, appear cheaper than domestic markets, with emerging markets being the rightmost plot, having levels at closer to the median level. In summary, I'd like to end by saying that U.S. and global economies appear to be on solid footing, and this looks likely to continue. There are some notable developments that we are watching. First, the U.S. output gap has largely closed, and the real Fed funds rate is becoming positive. Additionally, as we move into 2018, the reduction in global quantitative easing could start to put more upward pressure on interest rates. We will continue to monitor these developments and to assess if there's any changes that need to be warranted in our investments. I'd like to thank you for listening to this webcast and leave you with a note from our lawyers. Thanks.